The Rebel Capitalist Show. All right, guys, it gives me a great deal of pleasure to bring someone back to the Rebel Capitalist Show that I really enjoy talking to. He is a superstar on FinTwit. So if you're not following him, make sure you do so at the end of this interview. But his name is George Goncalves. George, welcome back to the Rebel Capitalist Show.
Feels like an eternity.
yeah,
Exactly.
It's been about 30 days, but in these types of markets, it feels like forever, doesn't it? So
100%.
What I wanted to do is just kind of get an update on the bond market and everything that's going on in the dollar funding markets, the repo markets, the Fed's balance sheet, and then just kind of go over a quick Q&A to get everyone up to speed.
Yeah, let's kind of start from the top, right? I mean, there's been a whole laundry list of new alphabet programs that have been launched by the Fed. I mean, we've had the traditional kind of QE expansion, but if you kind of bucket the two, well, if you think about the Fed's balance sheet as like there's liquidity programs and then there's actual outright QE. Okay. The outright QE has outpaced the liquidity programs this time versus what we saw in 2008. So, in our earlier show, we were discussing, they're going to bring back all of the ABCs. They brought back the commercial paper facility, the primary dealer credit facility, and discount window borrowing. The repo was already ongoing since September of last year.
Right.
But those were the liquidity programs. They were meant to be short-term in nature, although they've kind of been rolling for a while, at least the repo side. But the liquidity programs haven't really seen much take-up. I mean, there's also a money market fund liquidity facility that was also launched. They're relatively really small in comparison to what we saw in 2008. And I think that's probably the most glaring thing that makes this time period different from 2008, 2009 is that the Fed is really in here to support the treasury market and the mortgage market in size. I mean, 2/3, if not almost the majority, definitely the majority of all of the Fed balance sheet expansion came from those days when the Fed was buying $75 billion per day of treasuries, a boatload of mortgages. They've been slowing down that pace over the last month or so. But over almost $2 trillion or so, counting, because this is a running rate. I think by the time people look at it a week or so from now, and it's going to be over $7 trillion.
Exactly.
We started at $4 trillion, right? So the balance sheet, $4 trillion, going on 7, most likely going towards at least 9.
Just so everyone knows, it's April 29th today. Just as a
no,
reference point.
You have to kind of timestamp it.
Yeah.
Because we're literally, I mean, at the pace that they were going and what the capacity they have for these other liquidity programs, which I'm still downplaying because they're not being used to their full capacity, we could easily get towards 10 trillion. I mean, and we started at 4, and they were trying to shrink the balance sheet for a year and a half, 2 years, kind of deep six that, and here we are with a massive balance sheet.
Yeah, it's just amazing that even 2 months ago, if you would have said the Fed's balance sheet was going to be at 10 trillion, no one would have believed you. They would have laughed you out of the room. The one question I've got, though, when you say that the alphabet soup programs it's less now than it was in 2008, is that in terms of percentage or overall dollar amount?
Actually, that's a great question, because both in percentages, but as well as in dollar terms. So just kind of quickly looking at it, I mean, the lion's share of what's being used now is not an alphabet soup. It's the FX swap lines.
Yeah.
With the foreign central banks provide dollars. Those, as of last count, are about 400. We'll see what they are tomorrow when the Fed updates its balance sheet again.
Okay.
But
and that makes sense because of all the dollar-denominated debt that's outside the United States that we hear so much about from like Brent Johnson and Jeff Snyder, and the 13 trillion at a minimum that those entities need dollars to service that debt. So that would make a lot of sense.
But even at the 400 billion, it sounds like a big number, but it's actually really small because the Fed's balance sheet is going on 7, and as a percentage terms, it's really small.
Right.
And at the peak of the crisis in 2008, they were at about 600 billion. So we're still running lower than that. So it kind of starts to make you wonder, how much of this liquidity issue was more of a domestic problem. It was more of a, some of the things we discussed in our first interview on the lack of balance sheet for off-the-run treasuries, the lack of balance sheet for capital-intensive type trades that someone had to buy all that paper, and so I think to me it's really like you had that plus the fiscal spending that, someone had to buy all those treasuries, all of this, makes this Fed balance sheet expansion so much more unique, and it's more tailored towards fiscal and domestic locally versus a liquidity problem. I mean, the liquidity problem could still come, by the way, but what we're seeing now, they're not fully using those programs.
Are they buying the long end, or are they buying T-bills, or a mixture of both?
I mean, they're skewing more towards the back end, but I mean,
Right.
there's more of a kind of distribution around the curve. But it's still, I mean, we're talking about close to 2 trillion. And by the time this airs or whatever we get from tomorrow, we'll see a very large number of what was treasury buying, a decent amount of mortgage buying as well. And those were the two biggest components. I mean, if I look at, they've done about 100% more in the Fed balance sheet expansion versus 2008 in the initial kind of big ramp up. So the Fed's balance sheet exploded in 08.
Okay.
From 800 or so to close to 2 trillion. That 1.2, 1.3, we did 2.6 as of last week. So we've already done double of the speed of 08.
And how long did it take them to do that in 08?
It took them about fourth quarter of 08.
Okay, so,
we've done it in a month.
3 months we've done in 3 weeks.
Exactly.
Or we've done more, actually.
We doubled it. Yeah, we actually doubled that speed. And we're starting to slow down, and we're not seeing the liquidity usage. And so that to me is what makes this one a very unique. I mean, look, you could argue it should be unique because we're fighting a virus on the home front. We need to have the money, locally, but this is still links back to the issues that the repo market itself was dealing with, which was too much treasury debt in the system.
So if they're buying mostly long dated treasuries, I would assume that's to keep or try to keep the rates low at the long end of the curve, because a lot of the 10-year rates trickle out into the real economy through mortgages. I'd assume credit cards. Do you think that's their strategy with buying the long end, or is it more so what Snyder was saying, and that they don't want to buy T-bills anymore because that's the pristine collateral that's needed for the repo transactions?
Yeah, I think there's a combination of both. They're claiming it's not credit easing, and that's what we heard today also, because today was an official Fed meeting. They're back on schedule, so they had these emergency meetings throughout the last couple of weeks. This is the first official virtual version, like we're all used to at this point. And they made it clear that they don't view this as a credit easing QE. This is still trying to maintain market function. And so if you hark back to some of the things we mentioned and the things we've been writing about and reading, you need to keep the treasury market volatility very low, because it's like the foundation, the common building blocks of every single fixed income asset class in the US banking system and the US financial system at large. So you keep US rates volatility from not moving around that much. That then helps credit, that then helps mortgages. It helps the whole system at large not have to deal with liquidity risks and just kind of fire sales or gaps in pricing, which didn't make sense. Chair Powell today in the press conference actually said, hey, look, some of the things we've done we've said that we're going to do have actually worked before we've even done them. So they've kind of they launched it without actually firing any bullets. So it's really, it's went back to the confidence game of them saying, hey, look, we're doing the QEs to keep treasuries really locked down, not moving that much. If it helps mortgages, yeah, it will, but that's not the intent. The intent is really to reduce volatility in the system.
Yeah, it's really interesting you say that, George, because I interviewed Jeff Snyder last week, and the main part of our conversation dealt with the Fed and everything that it's doing, whether it's quantitative easing, whether it's the alphabet soup program, whether it's lowering interest rates. Jeff's opinion is that it's all a matter of psychology, and because very little of what the Fed does actually is that effective. It's more just, okay, it's more the market believing there's a Fed put. So when Powell comes out and says that he's going to support the market, the participants believe him. They just think it's going to be so. So it's a foregone conclusion. They come out and they hit the bid, and they're much more willing to be aggressive or not to sell. And so when you said that Powell came out and said that they've made progress in these programs are actually working, even though they haven't been put into effect, that's the first thing I thought of. is Snyder's conversation and saying how this is all just a psychological game that the Fed is playing. It really isn't about the expansion of the balance sheet.
Look, I think that's true. I mean, especially when it comes to like for the market that's not Treasury focused. For the Treasury market, it's really become really crucial and important to have the Fed there to keep rates low and volatility low, as I described before. But as what Jeff is saying is that, and I think Jeff has mentioned it a number of times, I've seen some of his pieces, is that they're not as central as they used to be. I mean, over time, that because there's been all these other financial institutions that have built up around the system, that takes some of the direct linkages back to the Fed. And in many ways, which is why they have to sound like they're doing bigger and bigger bazookas each time.
Yeah.
But just to kind of really hit it harder, to kind of really force it out there somewhere, and hopefully it works out. And really hope that they don't have to fully maximize. We're looking at some of these programs can get up to the corporate credit, $750 billion. I doubt that, or $800 billion. They're not going to want to get up that high. Do they want to buy 500 billion munis? They probably don't. I mean, they could, and they could do more. I mean, all these special vehicles that were established with the Treasury now give them latitude to really go beyond their original scope of just buying usually Treasuries and government guaranteed securities. But nonetheless, they don't want to get into the business of intervening in all these markets. They'd rather, in many ways, they're just capping the tail risk, right? They're like an insurance wrapper. They're like, hey, where are your insurance policy? You know that if you buy these securities, you can have an out. You can argue the merits of that on capitalism. Is that fair? Is that moral hazard? It's all that. But they're viewing it at this juncture, given the uncertainties that COVID's creating, they view it that they can cap the downside to allow markets to kind of figure out fair value.
Do you think there's a line they won't cross, George? Because, I mean, going back a month or 2 months, it was all the chatter was, well, the Fed won't do this because it's against the Federal Reserve Act. Oh, the Fed won't do this because it's against, and just the very next day, they completely ignore the law and just do it anyway, or they set up some special purpose vehicle. So in my mind, I just see it as the Fed will do anything to prevent the market from going lower. But do you think there's a line that they won't cross? And if it comes to, if rubber meets the road, they'll let the market tank and not cross that line?
See, that's a great question. And look, we're finding out firsthand that, when it gets a little dicey, they're quick to kind of come up with some new acronym and launch a program. There's really not much left though, right? I mean, there's just the equity market. I mean, that's really just, and there's been some debate around, how much can the Fed really do on the credit side, given some of the requirements, which they may be able to get over it if their lawyers look at it more closely, in the CARE Act, which says that they can only really lend to U.S. companies that are actually in the U.S. Mm-hmm. But there are ways that they try to kind of skirt around this. What's left is equities, and I guess private equity. That's really that's what's left. I mean, there's nothing much more that they haven't really put their fingers on. But again, I think it is 100% the confidence game. They would love nothing less than to do very little and let markets kind of find some sort of stable ground, instead of having to go to 12, 15 trillion balance sheet and just hoover up everything. Because at that point, you start to really take away the assets that the actual private sector needs. You cannot just take away everything from the private sector and leave them with reserves earning next to nothing.
Yeah, because that's another interesting topic that, I mean, I'm sure they're not there yet or even close, but what happens if the Fed just keeps buying all of these assets that are used as collateral in the dollar funding markets? Does that become it's obviously a problem because they stopped buying T-bills. And if my memory serves me right, when prior to the we'll call it the cerveza sickness, they were doing 60 billion a month, but they were just doing T-bills. And all of a sudden they found out, well, that's not good because we're taking collateral out of the system. So they moved further out the curve. So it goes back to my question. I mean, is there a point where they can just buy so much collateral that they're depriving the dollar funding market, and that becomes a bigger issue?
We're not there yet. I mean, I think that there is a limit. I haven't fully calibrated it, and I don't think anyone really knows precisely where that point is in time, in actual nominal levels, but also in time, because the economy now from 10 years ago is much larger than what it was, and each kind of iteration that we go through this, they do bigger and bigger programs, we dodge the bullet, and then we kind of like get into a glide path. This one's a little bit more tricky to kind of calibrate. We'll see. I think there is a limit, especially when it comes to what happens with corporates and pensions and and insurance companies. Like, what are they left with? Are they going to be left with just short-term assets earning next to nothing, which then their business models just don't operate, right? So
Right.
I think the Fed, acknowledges these things. They did a massive slug of taking down all this treasury supply, and will continue to buy a lot going forward, but not at 75 billion per day. And that will then give breathing room and just allow markets to kind of clear on their own. I mean, I think to me, like what I found so far, everything I've heard, and I was, a little bit distraught initially when I heard that they're going to go buy credit. I was like, they have no business buying credit and picking winners and losers. But the way they've structured it and the fact that it's going to be such a small piece of the puzzle, and they're only buying the short end of the credit market. Now, again, they could change all these rules. I grant that, but they're setting up to just, they're trying to be as conservative as possible to not be that lender of first resort and to take down all this paper and leave the system with nothing. So they're really trying to throw up as much as they can, some resistance, but without curtailing the availability of credit and cash flowing through the economy at a really precarious time.
Conservative is an interesting word to talk about the Fed right now, George.
No. Listen, trust me. That is me being as kind as I can be at this juncture.
I know.
And it's not meant to. It's like this is like relative value trading.
Right.
It's like,
right.
How bad was it from before? And before we're like, oh, they're going to take down everything. It's like, well, technically, maybe they won't take down everything, so it won't be that bad, and therefore there'll still be some price discovery left in the system. I mean, I think they would love to see nothing less than, we get through this weird period because earnings, we don't know what they really are in the economy.
Right.
We don't know how much cash flow is really going to kick off in that sense. Get to the next 2 quarters, see what happens with this virus and how we handle it, and then like what capacity is the economy at? If it's at 60%, then every asset class that I kind of look at that's risk market based is overvalued, and the Fed could allow them to, not gracefully, they're going to have like moments where we look up and say, that's not worth it there. It's going to come back down. The question is, do they draw a line in the sand? And what level is that line in the sand? Yeah. I think they just don't want, what was happening in March felt like a collapse, right? It felt like a collapse that could have made, 08 look like a walk in the park, right? If they did not really throw up a couple trillions, we could have been down, who knows how much would be down. We would have the building blocks, which are the treasuries again, would be infecting every single asset class. We cannot let that happen. It might eventually one day, who knows when in the future happen, but at this point, they're going to do their darndest to not let that happen on their watch. So treasuries are sacrosanct. They're going to be kind of, cared for. Mortgages similar. And then as you kind of go up the upside down pyramid of the risk spectrum, investors are going to have to figure out what fair value is.
Yeah.
And I think that's all they can do.
What do you think their limit is on the 10-year as far as rates?
So I'm actually, like, this is my own personal view, where I think where we're heading. I mean, considering that he sounded pretty neutral again for a Fed that just kind of went up a couple $1 trillion. It's hard to say that, but he was pretty like, hey, monetary policy is appropriate for now. They're not going to do negative rates. I don't think they'll do negative rates anytime soon. So all they really have left is the yield curve control and buying equities. You don't buy equities at the near high. So like they would have to go down and start to feel like they're in a free fall before, the Treasury would give the authority to actually somehow work out with Congress to set up an SPV to buy equities. That's like a worst case scenario for me. It would have to be much lower than these levels. And so it really comes down to the level of the 10-year. I think that they're going to want to do like a test here and see if they're buying less and less. Does that create a taper tantrum 2.0? Does that cause the 10-year to go back up to like 1%? Is that like the new ceiling for them? Will they come in and say, look, 1%, you're not going to go higher than that. We've been sitting under 1% since the volatility that we saw in March. So if we get into a period where, look, the economy is opening up slowly, people are going to get somewhat more optimistic that maybe we've dodged the worst case. And if the economy looks a little bit better into the summer and rates back up and there's all this Treasury long-term supply and the Fed is buying less, we can get to 1% on the 10-year. And then the question then does the Fed say, uh-oh, we're buying, 10 or 15 billion per day. We got to go back up to the big number to slow it down from it going to 2 or 3%, right? We're going to be in that kind of game for the next 3 to 4 months, in my humble opinion.
Okay.
And that will be the next iteration of Fed policy.
So obviously, if they're running more deficits, they're adding more supply of treasuries to the system. Although when they do a treasury auction, I'm not sure if they're doing, do they typically do all bills or all treasuries, or do they mix it up? Or
they mix it up. They have a standard schedule that they don't really deviate too much from, and so they have an X amount that they do per week, per month, that are allotted to the different points on the yield curve. And like we discussed last time, we mentioned that there's old treasuries and like new treasuries.
Yeah, right.
In many ways, the Fed just kind of retires the old treasuries. Every once in a while, it comes around, hoovers them up, retires them, and we have a whole new yield curve. That's all these new treasuries at much lower yields, and they're issued on a periodic basis.
So if there's a lot more supply, just assuming that the government is going to continue with the CARES Act, maybe they do UBI, who knows what they're doing. But the deficits, I heard the other day, for this year projected to be something like 3 trillion, or it was some crazy number. So if the government is producing a lot more supply of treasuries, I would assume that means the Fed has to buy more treasuries in order to keep the interest rate low. Or do you think that inflation expectations are so low that they might not have to do that? Or how does that all work out?
Yeah, look, that's what I'm trying to get at. There's this, I think we're now entering into the period where they're going to do some experimenting, not at the mercy of trying to let rates just kind of get out of control, because they would never let that happen. But we're locked, let's call it 50 basis points to 75 for basically a month now on the 10-year.
Yeah.
If supply kind of comes in and the Fed is buying less, all else equal, and if the other asset classes are still doing okay, the 10-year can go to 1%. And then what do they do then? Do they let it go even further than that? That's where I feel like the next policy, which I failed to mention the actual name, which everyone I think now has kind of gotten used to this name, the yield curve control.
Sure.
To kind of lock down certain points of the curve and don't let them get out of hand, because
World War II.
It's a World War II phenomenon. Japan's doing a similar version as well. And that is what allows you to kind of fund your deficits at a more favorable rate. Otherwise, a lot of these programs just won't compute, because the deficit operates okay with low rates, but if rates go higher, and you just can't handle the debt load and the interest servicing cost.
Right. We've got a lot of different cross currents right there with the supply, with the Fed coming in and buying. What do you think would be a catalyst for them to lower rates again? So in other words, they allow it to go to 1%. When it gets to 1%, assuming they do that, what are they looking for to determine, okay, we've gone too far? Are they watching the stock market, the S&P? Are they looking at something in the economy? Are they what metric are they fixated on?
So I think all of that, plus the initial thing, which they've been so successful because of all the money that they threw at it, they crushed volatility. So the market doesn't really move that much. So if it's an orderly rise back up in rates, so it has to be orderly, right? So hey, it doesn't. You're going to wake up one day it's at 50, and the next day it's at 1%. Like if it's at 0.5 and it's at 1, the next day, then we have an issue, right? So if it's orderly, if it's done and it's consistent with with the fundamentals, like we priced in a lot of the bad economic outlook, and now things are looking a little bit better. It might not last. It's a whole other topic. But if things look a little bit better and rates are rising because of this natural virtuous cycle, then that's the other criteria. And then of course, stock market cannot be falling out of bed either, because this is where I feel like this gets very tricky, because rates have been low and stocks have been able to kind of levitate. They've kind of done their own thing. If rates start to go up again, they're both competing with equities again, even though rates are low. If you want to lock in some of your gains, you can now get higher rates in the bond market if that were to happen. So you have that dynamic, but also what any policymaker will tell you if you really ask them, what really keeps them up at night is both bonds going down and equities going down. Like if there's nowhere to run, nowhere to hide, and it's just cash, and they clearly don't want people to be in cash. So if you have a situation where the bond market's not responding to their gestures, and equities are rolling over because people either take profits or they realize the economy is going to be that bad. That's like their worst case scenario. So, I think those three things kind of combined with other factors, with what's going on with the dollar globally, all those things will, play a role in when do they feel like enough is enough.
Do you think that because the Fed is printing a lot more money to buy treasuries or to buy mortgage-backed securities, I'm assuming they're buying the majority of those from the primary dealers, and they're doing a lot less with the alphabet soup stuff. Am I correct to assume that has the effect of producing fewer deposits in the real economy and more just plain bank reserves?
What I find interesting about the last 10 years is, coming out of the '08 crisis, everyone's like, oh, it's going to be a massive inflationary bubble. And what it was an inflationary bubble in financial assets, not so much in the real economy.
Right.
Right. Because it really never really escaped the closed network system. It just kind of got recirculated, rehypothecated through repo. It basically just expanded all financial valuations. But also, by the way, we were starting from very cheap valuations too, because we saw a big correction in equities and credit and housing. So things were cheap in '08 and '09, even 2010. Right now, things are not cheap. We're trying to do suspended animation, keep financial values high and not let them actually correct. I think in this is the instance where it might not be fully inflationary at this juncture, but the more that they do this, and if they don't unwind these programs 2-3 years down the road, it is going to be massively inflationary.
Yeah.
And that's where I've been a bomb bull, for those that know me, for over 20 years. I mean, I've been, started, when rates were kind of heading down and I'm like, they're never going to ever go back up again because we have so much debt load. We can't afford higher rates because the system won't work. So now we get to the kind of end game where they have to pin everything either through yield curve control or very low rates, but they're doing it through the QE channels and the expansion of the balance sheet. This is where I think the rubber hits the road. Whereas the people that got it wrong in '08 and '09 about inflationary risks, now they're going to start to percolate. And it won't come all of a sudden because we're still dealing with deflationary shocks if the economy is offline. But as the economy comes back online, as we change our supply chains, and bring a lot of the stuff back home, you're going to see, the M2 actually is, by the way, up a decent amount. So
in the last couple months, I know it's been up huge since 2008, but in the last few months,
I mean, on a year-on-year basis, it's pretty big. I have to go back and check. I have to look at it, but I think it's one of the biggest rises. So I feel like, and plus what's different is, in the past they would give us like a finite amount of like, this is how much QE we're going to do, so that a year from now the year-on-year change goes to zero, right, or just stops growing, right? But if they're committed to this until we get out of this crisis, who's going to take it back? Are they going to really? They couldn't unwind the QE1, QE2, QE3.
Right.
They're not going to unwind this one.
Right.
And it was half the size. So let's get to 8 to 10 trillion. You think they're going to go back to 4? No way, right? So this is where I think the rubber hits the road and it becomes inflationary. Now, the bond market's smart and sniffs those things out, but at the same time, it's trying to balance like how much buying the Fed is actually doing, which is pretty massive. And there is still a captive audience from these large investors that have to put their capital somewhere. But over time, they're going to start to kind of command a premium. And that premium will force curves to stay steep, inflation to kind of be embedded back into the curve. It will happen. And then we'll have moments where it happens all of a sudden. The Fed will have to then really buy a lot to kind of slow it down.
Yeah, but then they increase their balance sheet, which the market sees as inflationary. It exacerbates the problem to a certain extent. And one thing I'll try to think through it out loud here. I look at M2 since 2008, and it's just a hockey stick. But then to contrast that, you look at velocity. So if velocity would have stayed the same, most likely we would have had serious inflation. But
that's true.
Velocity
That's very true.
Went down pretty much as M2 went up. Do you think the reason why velocity fell off a cliff so much is because a lot of the broad money that was created went into the financial system or went into assets where the velocity just isn't as high as if it were to be in the checking account of the middle class and just the average Joe out there? That would be my first question. Do you think that's why the velocity tanked so much?
Yeah, I mean, because there's less turns, right? It's just not turning so much. I mean, it was captive in the financial system. This time, they're actually, there's distributions into small businesses. I mean, there should be more, in my humble opinion, but it's actually, making its way there, and a lot of it's either non-recourse or forgivable loans. I mean, that right there is inflationary, right?
Well, velocity for sure.
And velocity too, because it's just going to spike. So no, I think there's a whole host of reasons why this is different from before. 08 was a banking crisis. I mean, this one has the potential to become one if the Fed doesn't stay on top of it as it's doing now with all these programs. But they're going to, again, dampen volatility, kind of like numb us into this kind of slumber. But we're dealing with an economic fallout, which they cannot really fix because it's out of their control, right?
Okay.
It's similar for the fiscal side too. And they just have to kind of ride this out, and hopefully the economy bounces back in the next 18 months to 24 months. But the question we have to all ask ourselves, will they pull out the money that they put in? I'm saying pretty much no.
I mean, I'm no professional. I'm just an amateur. But from my standpoint, I don't see how on earth they can reduce the size of their balance sheet if it gets up to 10, 15, 20 trillion when they couldn't even reduce it at 4.5. I mean, they got it down to, I think, 3.7 before they had to put the brakes on. And so in my mind, the more they expand their balance sheet, the more the financial economy and the real economy gets addicted to the expansion of that balance sheet, or the more it's like an evolutionary process where the financial economy evolves, the real economy evolves, but it evolves around the Fed's balance sheet. So that's kind of the catalyst. That's the hub that makes everything work. So if because all of these economies are built on top of a balance sheet, you reduce the balance sheet, and all of a sudden the whole house of cards comes crashing in. That's kind of how I see it in my mind. But and I know you're short on time. I wanted to ask you a question, George, because I've been thinking about this, and I really wanted some professional insight on it. And I'm just, because I'm in Medellin, Colombia right now. And so most of my expenses are denominated in pesos, and I've lived outside the United States for a long time. So if I were to buy a bond, a US Treasury, let's say, I personally wouldn't be worried about domestic inflation inside the United States. The only thing I would be worried about is really the exchange rate. So when I look at the dollar, I see it as two separate entities or two separate currencies, the domestic dollar and then the international dollar that competes against euros, yen, etc.
Correct.
So whatever's happening to the domestic dollar, I don't really care. And I would assume that investors in Japan and Europe feel the same way. So I know that when we look at the bond market, we say, well, it's going to be, we've got that pressure coming up from inflation expectations. But if the majority of bondholders are actually outside of the United States, could they be looking at a different type of inflation than the market is looking at, just being domestic Americans looking at the CPI?
Look, there's a lot in what you just kind of laid out there, and unpacking it slowly, just thinking about, yes, there are multiple dollar regimes globally, and the largest one still is the US one, right? Because it's obviously our currency. But it's an artifact of the petrodollar. It's an artifact of just international trade. And there's so many different dimensions to it that what the Fed wanted to do now is avoid trying to fix everything at the same time, like fixing the Treasury volatility issue, fixing the lack of dollars that were going out of the country because we're just not consuming as much as before. And you see what's happening to commodities and oil prices; they're all cratering. So there's less actual dollars leaving the country to kind of replenish some of those obligations that they have, right? I mean, I think what we're coming up towards is at some point, rethinking, the dollar's role in the overall system. It doesn't happen overnight. None of these things happen overnight.
Right.
We're just kind of living through this continuum of time where inflation, yes, will happen. Can I guarantee you when it's going to exactly happen? I don't know. But I do know that I'm much more confident now than I was 10, 12 years ago.
But
And
when you say inflation, are you talking about the dollar going down on the DXY losing value, or are you talking about just local domestic consumer price inflation, the cost of food and your rent or education, healthcare going up?
I think a combination of both, but I think what will end up, this is where I become somewhat a little bit more optimistic on the long term. Like we're gonna have some weird version of the 1970s. Nothing ever repeats exactly the same, but you have a big explosion higher, a lot of deficit spending during the 60s, and you get this period where the only way you fix it is like with higher inflation to make it easier to kind of deal with all this debt overhang. That's for the domestic side. And then we went off the gold standard. Well, basically, we closed the gold window, and that led to the financialization of the whole U.S. banking system, which basically set set the kind of marching orders for the whole global financial system. Now we have a lot of emerging entrants into the financial system that are going to rethink. Like we just took on even more debt in the last 10 years. Like what were we thinking? We should have diversified our lending, or or thought of different ways of dealing with the U.S. Now you can say that there's a whole other apparatus that kind of enforces the dominance of the dollar, and that's true. But I think it's also in the interest of the U.S. to have a slightly weaker dollar too. So I think we're coming up to our period where people want to call it the Plaza Accord 2.0,
Right.
where there's going to be a devaluation of the dollar. And if you look at the Fed's balance sheet size as relative to GDP versus the size of all the other central banks globally, the Fed can dominate all other central banks if it wants to, and it probably will. So that plus what fiscal policy is doing, those two things, if you do it for long enough, 2, 3, 5, 10 years, you can get to a point where you bring back all your jobs from overseas. You change the supply chain. You change all these things. You can't do it overnight. You can't you have to be smart about what you bring back, and you bring back everything. But I think this is where I get more optimistic on the U.S. long term. But we're going to have our lumps along the way. And I think what the Fed is trying to do is provide a floor. We're going to test those floors every so often. And the question is, can we make new highs? I doubt it, in my humble opinion. It could happen just because there's a lot of easy money in the system, but it won't be sustainable. And so what we'll see is financial assets are still kind of operating to the last 10 years model. Like, oh, we're just going to keep going up because that's what we do. But in reality, I think we're going to see savings redirected back into bonds. We're going to probably see at some point, I think, just like we saw all these regulation that was enforced on banks, I wouldn't be surprised if there's going to be regulations forced on corporates and pensions that you have to own more treasuries, because we cannot just rely on the Fed. We need to have like domestic buyers that are there and ready to liquefy those treasuries if we have another pandemic or something to that effect. You can easily see how they can use this to force more domestic buying of treasuries.
Right.
And that takes all the foreign investors out of the equation. And then that by design, you get off the dollar standard over like a 5-10 year window. You could basically force everyone from pensions to corporates, because banks were forced through regulation to have these liquidity pools like the LCR and all these high quality assets that were supposed to hold them on their portfolio. They could do the same thing for corporates and say, listen, you have to do less stock buybacks and you have to buy more treasuries because we're going to have to issue a ton of them to keep funding this government to kind of keep things operational in the US as we bring back our manufacturing capacity. So that's where I think long-term we're heading. And that's how you get off this kind of dollar is the only medium of exchange.
Okay. Boy, there's a lot to unpack there, but I'm just so curious if they, well, number one, with the market, if the buybacks going back to 2010 are 90% of the market going up, if they're not allowed to do buybacks anymore, then where's your buyer other than the Fed for the market going back up to 30,000? That's something I've thought about quite a bit. And also, if what you're saying is they're going to take, and now we're going to have the corporate balance sheet compiled of a lot less of their own shares and a lot more treasuries. Well, now they're holding an asset that does not like inflation. So going back to the Fed pegging the yield curve, if by chance they got to a point where they couldn't continue to peg the yield curve because the market was just pushing up interest rates because of inflation expectations, and they somehow lost control, then the corporate balance sheet is now loaded with treasuries that will just get hammered when or if the Fed loses control of the long end of the curve. And so that puts more pressure on the Fed to peg the yield curve, which means more money printing, which could lead to even higher domestic inflation when you're looking at consumer prices. And then you combine that with the deglobalization and the supply chains coming back to the United States, which has to be inflationary, I would assume, because you're going from $2 an hour labor back to, call it $15 or $20 an hour labor. And boy, that seems like it could be no bueno right there.
It's no bueno, but listen, what they might, again, if they're doing the suspended animation and kind of flooring risk assets and they won't let them go down any further, we're just basically we're going to be exchanging one risk for another risk, which is we're exchanging liquidity and financial risk for inflation risk. Yeah, and so those corporate balance sheets, we've seen instances in the past where equities go down 50, 60%. So if they lose 10 or 20% because bonds go down in value, that's the price you pay for having to get bailed out over the last, 10, 20 years.
Yeah. All right, buddy. I just really appreciate your time. I know we were only supposed to go like 20 minutes. It's probably been about an hour. So I thank you for your time, buddy. And for those of my viewers who might want to find out more about you, I know you're super active on Twitter. You want to give out your handle and maybe your website?
Yeah, sure. I mean, for now, just kind of look me up on Twitter. It's at Bond Strategist. It's pretty easy. I'm the only one that has that. So, follow me. I appreciate it. And, I've been trying to at least kind of impart some of this wisdom and make sure people are aware of, there are, unique aspects to the bond market, which the everyday person doesn't really know. So financial literacy is something that I think, we really need to do. And you do a tremendous job. I see all the videos that you do. And I'm sure that helps a lot of people understand the complexities of the world that we live in.
All right, George, I appreciate it. And I can't wait to do it again.
Likewise. See ya.